Most people think that Social Security is just a retirement check based on their own work history. But what if you could qualify for benefits through a spouse, an ex-spouse, or even a deceased partner? And what if you're missing out on thousands in benefits that you didn't even know existed? In this Retirement Income School lesson, I'm walking you through the often overlooked benefits, spousal, survivor, and dependent, and showing you how to coordinate them with your overall retirement income plan. Let's make sure that you're getting everything you're entitled to and nothing is slipping through the cracks. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place to get a financial education where you'll learn how to protect your wealth and create guaranteed income so that you can retire financially relaxed. Let's dive into this lesson, which is part 2 of our Social Security series, where we're going to talk about Social Security spousal, survivor, and dependent benefits and what most people miss. Specifically, you're going to learn how spousal, survivor, and dependent benefits work and who qualifies. We're also going to dive into why dual entitlement rules and remarriage matter much more than you think, and how to coordinate benefits for your unique situation and income plan. And remember that this is a 3-part series, so if you haven't yet listened to part 1, you're going to want to go back and listen to part 1. If you're watching on YouTube, it's called Part 1, Is Social Security Going Broke? The Truth You Need to Know. The link will be in the show notes. If you're listening on the podcast, it's the episode right before this one. And in the 3rd, you're going to learn how to maximize your Social Security benefits by watching me do a live RSSA Roadmap walkthrough and then making sure that you go and get yours. Go to socialsecurity.solutions, and that will give you the link to do your RSSA roadmap, and then I'll reach out to you after you complete it and we'll schedule a one-on-one meeting so we can talk about your unique situation and I can help you decide on the optimal strategy for you to claim your Social Security benefits. And before we fully dive in today, I want to make sure that you hear this disclaimer. I am a registered Social Security analyst. That's what RSSA stands for. And that means that I'm an independent professional. I'm not in any way employed by or affiliated with the Social Security Administration or any other government agency. The Social Security information that I provide in these lessons is for general informational purposes and is not intended to constitute financial, legal, or tax advice. Be sure to reach out to a professional for all of those things. I can help you with your Social Security claiming strategy, but I just want you to know that I'm not employed by the Social Security Administration. And again, if you want your roadmap, just go to socialsecurity.solutions. As we're going through the content today, I want to just say if you're listening on the podcast, there are slides that I'm going through on YouTube. So if you're more of a visual learner, you might want to go there. Just go to my Retirement Income School YouTube channel. Links are in the show notes, or you can just type in Retirement Income School on YouTube. And know that most of the lessons that I do here are given both in the podcast version and in YouTube version. So whatever way you like to learn, there are a lot of different options for you to be able to plug into school lessons. And with that, let's dive into this lesson where we're talking about Social Security benefits. Have you ever wondered how Social Security benefits are calculated? I've heard all kinds of myths from different people. Some will say it's based on your last 3 years of work, or it's based on your highest 3 years, or it's based on 10 years, and so many different combinations. But the truth is that your Social Security retirement benefit is calculated based on your highest 35 years of earnings. So those 35 years include a combination of indexed earnings and face value earnings. So here's how that works. Any income that you've earned before the age of 60 is adjusted for inflation, and that's called indexing. For example, if you've earned $50,000, let's say in 1990, then the amount might be worth $70,000 today after adjusting for inflation. Then you look at earnings from age 60 and beyond, and those are counted at face value, meaning if you earned $50,000 at age 62, it's going to count as $50,000. So once you determine your top 35 years of earnings, including zeros for any years you didn't work, they're all added together. And that total is used to calculate your average indexed monthly earnings, or AIME, AIME, which is the first step in determining your retirement benefits based on your own record. So that's how those benefits are calculated. The next step in calculating your Social Security benefit is determining your primary insurance amount, or your PIA. So your PIA is the monthly benefit that you would receive at your full retirement age. In other words, it represents 100% of your earned benefits. So that's why both your full retirement age and your PIA are so important. And all other benefit adjustments, early or delayed, are based on this number. So how is your PIA calculated? It's actually calculated using your top 35 indexed earning years and then broken down by a 3-step formula. So it's based on something called bend points, and bend points are income thresholds that are set by the Social Security Administration. Each year, the SSA updates these bend points, and the ones used in your calculation are based on the year that you turn age 62. So if you turned 62 in 2020, your bend points would be different from someone who turned 62 in 2023. These bend points, combined with specific percentages, are applied to your average indexed monthly earnings. So your PIA is based on your AIME using bend points. And I'm giving you this information so you understand the background of how your benefits are calculated, but don't worry about crunching the numbers yourself, because this is where I come in. When you complete your Social Security Roadmap, I'll provide a full analysis that calculates all of this for you. It's personalized to your unique earnings history and claiming options so that you can make confident and informed decisions. So when I was studying for the RSSA and learning everything I could about Social Security, I had to manually calculate all of this using different bend points and different percentages to understand how this works. But the really cool thing about the Roadmap software is that it does all of this for you. You upload your report from the Social Security Administration. There's step-by-step instructions on how to do this. And then it magically calculates all of this for you. And then we go over it to help you understand your PIA and different claiming strategies. So go to socialsecurity.solutions, which is plural. The link is in the show notes if you just want to click on that link, and you can start this process to understand your primary insurance amount, and then we can explore different claiming strategies. So I just like to give you that big overview so that you're understanding how these numbers are calculated. Now, to qualify for Social Security retirement benefits, you need at least 40 credits, also known as quarters of coverage. And you can earn up to 4 credits per year. So typically about 10 years of work is enough to meet this requirement. And you can go see how many credits you've earned by just logging into your Social Security account. So the official site that you want to go to for that is SSA, which stands for Social Security Administration.gov, SSA.gov. And you will just log in. If you haven't ever done it, create an account there, and it will show you your quarters of credit. And no matter what your age is, you can go there to look at that because you've paid into Social Security. If you haven't paid into Social Security yet, then nothing would be there for you. So the first requirement in order to receive benefits is that you have to have a history of work. And the second requirement is age. So in order to claim Social Security benefits, if it's been based on your working history, then you must be at least 62 years old. And specifically, you must be 62 for a full calendar month before you're eligible to begin collecting benefits. So benefits start at 62 when you can claim all the way through 70. And that is at the time of this recording in 2025. Something could change in the future, but the current claimant age is between 62 to 70. Now, as I covered earlier, once you qualify, your benefit is calculated using your top 35 years of earnings, which are used to determine your primary insurance amount, and that's your full benefit if you claim at your full retirement age. But here's where timing matters. If you collect before your FRA, your full retirement age, your benefit is reduced for each month you claim early. If you wait until your full retirement age, then your benefit increases by 8% per year. But what's really interesting that a lot of people don't know is that this increase actually accrues monthly. So that means for every month that you wait beyond your full retirement age, your benefit goes up by about 0.67%. So let's think of an example here. Let's say that you have an FRA, a full retirement age of age 67. If you're looking at the slide, you'll see that on full retirement age at age 67, and a PIA of $3,000. So at 67, you would be receiving $3,000 per month. And you can see how that's 100%. So you're 67, you get 100% of your primary insurance amount. But let's say that you decide you want to take it early at age 62. Well, now you're going to get only 70% of your PIA, which would be $2,100 a month. Or let's say that you decide to wait until age 70, then you receive 124% of your primary insurance amount, which would increase your PIA to $3,720. So your benefit amount is going to vary based on when you decide to claim. And that's why claiming strategy matters. If we all claimed at the exact same age and there weren't these reductions or increases in our primary insurance amount, then there wouldn't be a lot to strategize. That's why you want to consider, what is the right age for me? And this is going to vary a lot dependent on your unique situation. It depends on your spouse's age. It's going to depend on how long you think you're going to live. It might depend on if you have other income flow to meet your income floor and you want to wait to be able to get the biggest increase in your Social Security benefits. So you have other income coming in to fill that income gap. And then that allows you to wait to get 124% of your benefit. Or let's say that when you retire, you really want the benefit now because you know that you might have a shorter life expectancy. For some reason, you're aware of that. So you want to claim earlier so that you can have that monthly cash flow to enjoy your life before you pass. So there are a lot of different reasons that you would want to claim at different ages. I just want to give you the background so you understand how you're going to start to frame your decision based on these different primary insurance amounts and what your full retirement age is. Now let's talk about spousal benefits for both married and divorced individuals. If you're currently married or you plan to be, you may be eligible for a spousal benefit after 1 full year of marriage. So you must be married for at least 12 months to qualify for spousal benefits. And to collect a spousal benefit, your spouse must have earned enough credits to qualify for their own retirement benefit. So remember, we just talked about the credits. They must have their credits in order for you to qualify for the benefit. But here's the good news. You don't need to have 40 credits of your own. So if you think about the history of Social Security, this makes sense because it used to be most typical for the primary breadwinner to be male and that the wife often stayed home to care for the kids or made a lot less money or worked less years. And so that's how this got set up historically. These Social Security benefits were there to provide for the family in part for their income. So if you were, let's say, a stay-at-home mom and the primary breadwinner worked, you didn't have to have your own credits in order to qualify for spousal benefits or survivor benefits, as you'll learn in a little bit. So in some cases, you might be eligible for both your own retirement benefit and a spousal benefit. And this is called dual entitlement. And we'll talk about how that works in a moment. It's also important for you to know that collecting a benefit based on someone else's record, whether you're a spouse or an ex-spouse, does not reduce their benefit in any way. So you're not taking anything away from them by claiming spousal benefits. And there are 2 additional eligibility requirements for spousal benefits. You must be at least 62 years old, and your spouse must be already collecting their own retirement benefit. You cannot collect a spousal benefit unless they've filed for theirs first. And then when it comes to the amount, a spousal benefit is based on your spouse's primary insurance amount, not their current benefit. So at most, you can receive up to 50% of their PIA, their primary insurance amount, if you want to wait until your full retirement age. If you claim early, the benefit is reduced. Here's where strategy again becomes very important because you want to think about the differences in the amount you're going to get based on the age that you claim. So the key difference between spousal and retirement benefits is this. Spousal benefits don't grow after full retirement age. So it's really important to remember they don't grow after full retirement age. I've seen people wait to claim thinking that they're going to get more if they wait until 70 for spousal benefits, and they actually just wasted years that they could be getting that full benefit because they think they're going to get an increase like they do on their own retirement benefits, but they don't. So this is again where it's important to know the details of claiming. So remember, retirement benefits increase through age 70. That's your own retirement benefits. But spousal benefits cap out at 50% of the PIA and do not grow beyond that. So retirement benefits and spousal benefits have different rules. And let's talk about divorced spousal benefits, which work similarly with a few added rules. To qualify for a benefit based on your ex-spouse's record, you must have been married for at least 10 years. Both you and your ex must be at least 62 years old, and you must be currently unmarried. For you as the person who's going to claim spousal divorced benefits, you've got to have been married for 10 years, you and your ex must be 62, and you must be currently unmarried. And then there's one more important rule. If you've been divorced less than 2 years, your ex must be collecting their benefit in order for you to collect yours. But if you've been divorced for more than 2 years, your ex does not need to be collecting. So this is called being independently entitled to benefits. And I really think this is something a lot of people don't know, that you can claim ex-spousal benefits. So that could be something that's really important for you or some of your friends to know if they're at this age where they've been divorced, maybe they're now single, and they have an ex-spouse that has a higher benefit and they can claim those spousal benefits. It's important to know that that's an option. You could be missing out on thousands of dollars if you don't know that you can claim ex-spousal benefits. So keep that in mind if that's your situation. For dual entitlement, if you're a lower earning spouse but still qualify for your own retirement benefit, you may be considered dually entitled. So if you're watching on YouTube, let's just look at this chart a little bit. We've got the claimant age, we've got monthly benefits, and then the percent of spouse's primary insurance amount. So notice here, like I said, at 67, the full retirement age, you can get 50% of the spouse's primary insurance amount. But notice at age 68, it doesn't change. It's still 50%. Age 69, it's still 50%. Age 70, it's still 50%. So be sure that if you are wanting to claim a spousal benefit and their amount is going to be more than yours at that 50% mark, claim it at your full retirement age. You can also claim earlier at, let's say, age 62, but then you're only going to receive 32.5% of the PIA of your spouse's amount. And that's going to be for the rest of your life because you claim those benefits once. So that's why you want to consider claiming strategy. Now for dual entitlement, here's how this works. If you're a lower earning spouse, you still qualify for your own retirement benefit, but you also may be considered dually entitled. This means that you could receive a portion of your own retirement benefit and a spousal benefit based on your spouse or ex-spouse's record. So these are technically two separate benefits, and you won't receive both added together. Instead, you receive whichever benefit is higher. Here's how it works. If your own benefit is higher than the spousal benefit, you'll just receive your own. Let's say in your partnership, you're making more money than the spouse, well, then you're just going to receive your own retirement benefit. But let's say the spouse has a higher benefit, then you'll receive your benefit plus a supplemental amount from your spouse's record up to the full spousal benefit amount. They call this a top-off benefit. So let's walk through what dual entitlement looks like if you claim benefits at your full retirement age and your spouse earned more than you. So let's say that your own PIA is lower than your spouse's. In this version right here, we're looking at how your benefit at full retirement age is $1,000. Your spousal top-off is $500, and this means that your total benefit is $1,500. So what this means is that you receive your own $1,000, and Social Security adds a $500 spousal top-off, giving you a total benefit of $1,500, which equals the full 50% of your spouse's PIA plus your earned benefit. This is how dual entitlement works. You don't receive both full benefits, you just receive your own benefit plus a spousal supplement or top off. And you'll notice in this chart here that the total amount at your full retirement age is $1,500. So after full retirement age, this number doesn't increase. So you'll notice that your own retirement benefit starts to increase. So at 68, if your full retirement PIA was 1,000, well, at 68, you've gotten an increase of 8%. So now you're at 1,080. This means the spousal top off decreases. It's no longer 500. Now it's 420 to add up to 1,500. At 69, you got another 8% if you waited to claim until then. So you've got 1,116 for your primary insurance amount. Now your spousal top off benefit goes down to 384 to total 1,500. And then at 70, the same thing happens again. So you'll notice that after full retirement age, that total amount doesn't change. It just changes whether it's coming from your retirement benefit or your spousal top off to combine to equal that total amount. And this probably will make a lot more sense if you're looking at this slide on YouTube. But if you're listening, you can get the gist of it and at least understand the concepts. Now let's think about survivor benefits. What's interesting is that survivor benefits are one of the most underutilized Social Security benefits according to the Social Security Administration. Why is that the case? It's because the rules are complex and many people just simply don't know that they qualify. I said this in the last lesson, thinking about how a lot of people just think about Social Security as retirement and aging. They don't necessarily think about the survivor part of Social Security. So here's how survivor benefits work. They're generally based on the deceased spouse's benefit amount, either what they were collecting at the time of death or what they would have been eligible to receive. If the higher earning spouse passes away, the surviving lower earning spouse may be eligible to receive the higher benefit. And if the higher earner is the survivor, they simply just continue to receive their own benefit. So survivor benefits matter to you when the deceased made more money and has a higher benefit. Much like with spousal benefits, dual entitlement rules will apply. This means that the surviving spouse won't receive any benefits in full. Instead, they're going to receive a combination of their own benefit plus a portion of the survivor benefit equaling the higher amount. It's important to note that survivor benefits have a different full retirement age than retirement or spousal benefits. In most cases, you can receive 100% of a survivor benefit 4 months earlier than your standard full retirement age. For example, if your retirement FRA is 66 and 4 months, your survivor FRA would be 66. And survivor benefits can also apply to eligible dependents who may receive up to 75% of the deceased parent's primary insurance amount. And I'll cover more on dependent eligibility next. Just remember that because survivor benefits can get complicated and the impact is often very significant, this is a benefit that should be evaluated carefully on a case-by-case basis. And this can be a godsend for people who don't know about it. Let's say that you have a spouse pass early and they were the primary breadwinner and you have young kids in the home and you're taking care of them. You can receive a benefit for yourself as the caregiver and also for your dependent children. And for survivor requirements for yourself, you must be at least 60 years old or 50 if you're disabled. Must have been married at least 9 months if spouse is your current spouse, or if divorced, you must have been married for at least 10 years. And for the benefit amounts, the maximum survivor benefit is available at your full retirement age, and the benefit is reduced if you claim before your full retirement age. So you can see here these numbers indicated in red. If you file early, you're going to receive a smaller benefit. So at 60 years old, you'd get a 71.5% benefit instead of that 100% that you'd get at full retirement age. Often this is the case that you need to file early if you have dependents in the home or haven't worked for a long time, and let's say you had an older spouse that passed or a spouse that passed early for some reason, you might need to claim those early. So let's talk about dependent benefits. This is a lesser known part of Social Security that can apply to both living and deceased parents. To qualify for a dependent benefit, you must have a child under age 18, a child under 19 who is still in high school, or a disabled adult child, as long as the disability began before age 22. In some cases, younger spouses may qualify for what's called an in-care spousal benefit. So this allows a spouse of any age to collect a benefit if they're caring for a child under age 16 or a disabled child, even if they're not yet eligible for standard spousal benefits. So this is really important if you are in a relationship with an older partner or a partner who passed early and you have dependents in the home. Now, here's something many people don't realize is that dependent benefits are not just for families of deceased workers, they also apply while the parent is living, but with different benefit amounts. So here's the difference. If a parent is alive and collecting, dependents may receive up to 50% of the parent's primary insurance amount. If the parent is deceased, eligible dependents may receive up to 75% of the deceased parent's amounts. But here's the catch. These benefits are capped by something that's called the family maximum. So the family maximum limits the total amount of Social Security that can be paid out on one person's record. It's calculated using the parent's primary insurance amount and a specific formula provided by the SSA. And here's how it works. The SSA calculates the total family maximum based on the parent's PIA. Then the parent's own benefit is subtracted, and the remaining amount is divided equally among all eligible dependents. So here's an example. Let's say that the parent's PIA is $3,000 and the family maximum is $5,000. So this leaves $2,000 for dependents. If there are 3 dependents, then each is going to receive $667 per month, so $2,000 divided by 3. If there are 8 dependents, each can receive $250 per month, $2,000 divided by 8. So there's that family maximum benefit, and it limits the total benefits that Social Security will pay out based on one worker's earning records. And just think about it as no matter how many benefits are eligible, the total payout won't exceed the family maximum. The available amount is just simply split. So understanding dependent benefits and the family maximum is critical for families with children, disabled adult dependents, or blended households. And it's another reason why personalized Social Security planning really matters. Let's talk about the WEP and the GPO. Some of you may have heard of this recently in the news. There was a law related to Social Security, the Social Security Fairness Act, where the non-covered pension rule was repealed in January of 2025. So before this law was passed, certain workers were impacted by what's known as non-covered pensions. These are pensions from jobs where Social Security taxes were not withheld. So this meant that during those years of employment, workers were paying into a pension plan instead of Social Security. And this often applied to government roles like teachers, firefighters, police officers, local and state government employees. However, the impact varied by state. Some states required workers to pay into both Social Security and a pension system, while others only required contributions to a pension. So under the old rules, people with non-covered pensions could have their Social Security benefits reduced by 2 lesser-known rules. Number 1, the windfall elimination provision, or the WEP, and this affected retirement and disability benefits. And then the second was the government pension offset, or GPO, which affected spousal and survivor benefits. So these provisions could significantly reduce benefits, and they impacted an estimated 2 to 3 million retirees. But under the newly passed Social Security Fairness Act, workers with non-covered pensions will no longer face WEP or GPO reductions. So this means that their Social Security benefits, including spousal or survivor benefits, will no longer be offset by their public pension income. This is an important shift that could significantly increase benefits for those who were previously penalized. Now let's wrap up with an important topic that often causes confusion, the earnings test, which is also known as the earnings limit. And this is a rule that applies to anyone who is collecting Social Security benefits while they're still working, but only if you start collecting before reaching your full retirement age. So you've heard me talk a lot about FRA, full retirement age, and PIA, primary insurance amount. And those are such important terms to know because so much revolves around that in terms of your income and the earnings test, survivor benefits, retirement benefits, spousal benefits. So those are important things for you to know for yourself. What is my full retirement age and how does it impact me in these various ways? Here, when we're thinking about the earnings test, once you reach your full retirement age, the earnings limit no longer applies and your benefits are no longer reduced due to work income. So once you reach your full retirement age, no more earnings limit applies. There are two key limits to understand for 2025. Number one, before the year you reach your full retirement age, if you're collecting benefits and still working between age 62 and the year before your full retirement age, you can earn up to $23,400. If you earn more than that, then $1 in benefits is withheld for every $2 you earn above the limit. Number two, in the year that you reach full retirement age, but before your birthday month, you can earn up to $62,160. And these are 2025 numbers, of course. If you're above that amount, then $1 is withheld for every $3 you earn over the limit. And again, this only applies up to the month that you reach full retirement age. Once you hit your full retirement age, you can earn as much as you want without impacting your benefits. Also, it's important to understand for the earnings test what types of income count toward this. Only earned income counts, meaning wages from employment or net earnings from self-employment. What does not count is pensions, annuities, IRA or 401k withdrawals, investment income, rental income. So you want to be thinking about these things when you're strategizing around, am I going to work after age 62? How is that going to impact my Social Security? How can I optimize my strategy if I choose to keep working? The more and more that I've worked with different types of people, some people never want to retire and they want to work until the last possible minute they can because they enjoy working or they want more income or they feel like they'd be bored at home or bored in those retirement activities. Everybody's very different. Some people want to retire at 59 and a half because that's when they can start drawing from certain retirement accounts without penalties. Everybody's very unique. It's just important for you to know these rules so that you can decide where you're going to get your income from to meet that income floor that we've talked about. So if you're receiving Social Security benefits and maybe you're getting an annuity payout and a pension payout, and you're also using your whole life policy to create that income floor, you want to know what rules apply so that you know the actual amount that you're going to get. So if you plan to work and collect benefits before your full retirement age, it's essential to consider how the earnings test might impact your cash flow and then time your claim accordingly. Again, that's why I'm here to help you know when you need an annuity to fill in the gap of your expenses and income so that you can fully enjoy retirement because you know you've got that income floor met. With that said, remember that you can go and get your own RSSA Roadmap by going to socialsecurity.solutions. Some people just want to see those numbers and that's all they want from that report. Or once you fill out the information, you can schedule an appointment with me to look at your full report and discuss claiming strategy to help you meet that income floor and fully relax in retirement. And last, if you haven't yet subscribed to the Retirement Income School, be sure to do so either on the podcast or on YouTube. Click on the notification bell so that you never miss out on a lesson. And keep on hanging out with me here at the Retirement Income School, where I will bring you lessons to help you keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.